time for the MF Corner on the show, and we have our expert Dhirendra as always. When times are uncertain and markets are volatile, it's best to take a cautious approach to investing to avoid too much pain. Dhirendra, our expert and the CEO of Value Research, joins us on the show today to construct a conservative yet stable portfolio. Afternoon, Dhirendra. What makes up for a conservative portfolio? Typically, what kind of an asset mix does it have?
Normally, when we designed this portfolio about 3 years back, we targeted a 70% allocation to fixed income and 30% to equity. And this is still a growth portfolio, so to say, and for the risk-averse investor. And the way it was built, the way the portfolio was constructed, it was expected that on occasion it will be about 40-45. It can go up to 40-45% into equity, and today it is getting into the higher band of that allocation. And that is achieved. Of course, the investor does not have to intervene in this. One of the components of this portfolio is the dynamic PE ratio fund, where the allocation to equity changes. And so if the market gets very cheap, and of course that also means that market gets very scary, then that's the point when the equity allocation can be higher, and we are getting very closer to that.
Dhirendra, afternoon. Now tell us what kind of investors should be looking at this kind of a portfolio, and what should be the ideal investment horizon then?
It is still a long-term portfolio. Somebody who is risk-averse, it cannot withstand the volatility of equity or an equity portfolio. So this is 50 to 70% into fixed income. So in the worst case, so we are basically targeting, this is primarily meant for a risk-averse investor wanting growth at the same time, has very low appetite for the volatility, and that is reasonably mitigated with this allocation.
Let's also take in some viewer queries on the MF Corner. And our first query from Anup Kumar Datta Dhirendra. He wants to invest about $1 lakh a month in non-equity funds. He wants to know if it's a good idea to invest in a few funds, and he listed a few names: Birla Sun Life Dynamic Bond Fund, SBI Dynamic Bond Fund, Pramerica Credit Opportunities Fund, and the Tata Floater. Which one of these would you recommend?
I would say that for somebody seeking investing and is risk averse and looking only at the fixed income universe, one should consider only dynamic fund at this point. One should avoid the credit opportunity fund for the kind of weather we are getting into, and avoiding the floater fund because it is almost like a liquid fund. One is unlikely to be in coming times we are unlikely, it will be a very modest return on that. So dynamic fund looks most appropriate today, that you will be able to derive optimum return. At the same time, just in case the rate outlook changes, these funds will be able to capitalize on those opportunities.
Okay, on to the next query then. This one comes in from a viewer in Mumbai who wants to know how one can find out the face value of the units prevailing at the time of the initial public issue, Dhirendra.
Look at your own account statement. Of course, the face value becomes history, but it's not very complex. My understanding is that most mutual fund in this country had a face value of 10 rupee, and only liquid fund of late, they are coming with a face value of 1,000 rupee, and you don't have many other, other denomination to choose from. So looking at the level of NAV and the life of the fund, you can get a reasonably accurate, reasonably okay guess on the face value.